Trader's perspective from Larry Shover. He's Chief Investment Officer at SFG Alternatives, trades commodities among other assets. Joining us live now from the CME Group in Chicago. Larry, good to see you today. Let's start off very quickly with oil. Matt was just talking to Fidel Gate. Very bullish. His outlook for oil. Is yours the same?
I'm bullish, not as bullish as he is, but the fact of the matter is, no matter what happens with demand destruction in a recession in Europe, what happens in the U.S. really doesn't matter. The emerging markets are going to keep gobbling up the oil. I think $100 a barrel is going to be the low, and we're probably going to see 110, 120 by mid-year, no matter what happens.
You sound like you believe more in demand driving oil prices, and Fidel was sort of talking a little bit about speculation in driving the price up just recently. Is that also true for what we have seen with gold? I mean, that was sort of the safe haven of 2011, but lately it's sort of moving. It seems like it's more linked to the dollar than anything else.
Yeah, you know, gold's been correlated to so many different things that it's hard to keep track, whether it's sovereign spreads, safe haven, what have you. The fact of the matter is that gold, the fundamentals have not changed, and they will not change this year. Money is going to remain cheap, sovereign spreads are going to remain high, and there's going to continue to be inflation fears. Why we're seeing so much volatility is the central banks are unloading gold at any sign of liquidity issues. I mean, the real problem in Europe is solvency. It's not liquidity, but the intermediate problem is liquidity, so they're going to be dumping gold. But I do have to say that gold will end up higher in 2012 than it began this year so far.
Hey, I wonder about the transparency of the gold market. I mean, how hard is it for you to see if central banks are dumping their gold? How hard is it for you to tell if large groups of people in India are buying or selling gold?
Yeah, you know, that's just a profound question, because the gold market actually is very small, and no one really knows what's going on until we read the papers the next day. And so that's what makes it so volatile, and actually more of a trader's market than an investor's market. An investor has to buy it when we have a big pullback and realize that, hey, central banks have sold it, buy it and just hold on to it and forget about it.
I wonder what you do. Actually, I was just talking to somebody down here on the floor who has been buying gold for 10 years. Where does he sell it? I asked him. He doesn't know. So that's, I think, one problem for the retail investor. We're going to take a break. Thanks so much for joining us. We're taking a break here on Street Smart.